Coming up, the oil price surges. We take a look at the AI outlook, and a new entry for the ASX makes a pretty good debut. All of that and more next. Hi everyone, welcome to the SBS on the Money podcast for this Thursday, the 9th of July 2026. It's a day where the Australian share market fell. It fell by about 0.3%, but it was also a day where the ASX saw its biggest listing so far this year. We'll tell you about that in a bit. But first, to the share market, the ASX 200 down for a fourth consecutive session after an escalation of the war in the Middle East. Brent crude jumping again, edging closer to $80 a barrel, and is now up around 11% over the past 2 days. Unsurprisingly, energy stocks did best today, while gold fell and Telstra added 1.2%. For more on the day's market action, I spoke with Nick Schoenmaker from Portfolio Construction Management. So Nick, the market is down again today. Run us through what's driving investor sentiment.
Yeah, so I guess markets are really being driven by essentially two powerful but opposing forces, the AI optimism and then the oil price-driven inflation fears. So ASX is weaker today, as you've alluded to, and that's largely due to investors now reassessing inflation risk and what that means for monetary policy. The energy price is up about 11% this week after this memorandum of understanding, which seems more like a memorandum of misunderstanding. We've seen the risk flares up again in the Middle East and quite aggressive action taken there. So higher oil prices obviously matter because they feed into inflation. Interesting, inflation swaps haven't moved too much, even though the oil price has gone up, but the bond markets have reacted. We've seen a sell-off or a rise in yields, and particularly in those high beta markets like the UK and the gilt market. So investors at the same time are also digesting the minutes from the Federal Reserve, and we saw Kevin Walsh as the new Fed chair come in recently, and he did a number of things, Ricardo, to see interest rate hike expectations get priced into the market at the time, and that was more of a focus on inflation being above 2% for a considerable period of time, and moving really the emphasis away from the dual mandate, which is unemployment or full employment and inflation, and focusing more on inflation, removing dot plots, removing forward guidance, so a lot more data dependent. So this situation now in the Middle East has exacerbated that. The AI story still remains, really supportive for growth assets overall, but oil and inflation have temporarily taken centre stage. So that's where markets are grappling those two forces.
Can we break some of that up, right? Oil prices, as you mentioned, it's jumped again today. Over the past 48 hours, Brent crude has surged around 11%. It's now approaching $80 on these renewed tensions in the Middle East. As you mentioned, it's bringing up, questions about what does it mean for inflation? And what's interesting is that commentary from the Federal Reserve minutes, which came out today. Obviously, that meeting predates the latest escalation. So how significant is this for the market and investors?
Yeah, well, it's a really good point. I didn't actually mention that when I was talking about Kevin Walsh, but you're correct in that the minutes came out and they did actually emphasise the war in the Middle East having inflationary impacts. And even if there was a resolution there, you've still got all these bottlenecks from damaged infrastructure, insurance costs going up to get ships through. There's a whole bunch of second order effects that affect inflation that haven't come through yet, food, fertiliser, so many things. So oil is the macro transmission mechanism at the moment. And so it's not really that the markets are focused on the conflict itself, but they're focused on what it means for oil supply. And the Strait of Hormuz is still one of the world's most important energy choke points. And tanker traffic remains, materially below normal levels. So if we see oil being elevated, well, inflation rises, freight costs rise, household budgets, which is a major thing throughout the developed world, come under pressure. And central banks really face a difficult task then, because you've got supply side shocks that don't really get effectively dealt with from monetary policy, which is a rather blunt tool, and it kind of increases that K-shaped inequality that we have. So central banks face a really difficult task. And for Australia and the RBA, it's really important question is imported inflation now being a bigger risk locally. So it's not the geopolitics itself. Markets tend to look through that, and I could talk to you separately in a whole nother day about whether that's right or wrong, but the key issue is whether oil prices start feeding back into inflation, interest rate expectations, and inflation swap markets, which haven't moved too much, as I said, for now.
Okay, we were also briefly talking about the AI story. There's been some extraordinary gains in related stocks over the past few years, but to what extent are investors now starting to question the huge amount of investment listed companies are making on such technologies and whether or not they're justified? And I note just a few days ago, Samsung shares were smashed despite it posting, something like $80 billion in sales, yet investors are going, hold on, what happens next?
Yeah, so we've had, just as a general theme, we've had a lot of single stock volatility this year. And if you look at the VIX versus the NASDAQ volatility measure, the NASDAQ volatility is materially high. So there is this big rotation almost violently within the AI ecosystem. And so it's, to answer the question, it's investors are really no longer just rewarding the AI spending alone. So a lot of the hyperscalers, massive amounts of AI capex, they can still be profitable, but they can then not have strong free cash flow because you've got operating cash flow minus capex is free cash flow. So there's a focus on that. So it's not that anyone's questioning whether AI is important. It's questioning about valuation and timing. And now companies needing to demonstrate really a return on the enormous amount of money being invested. And to Samsung, so as you said, delivered really strong earnings, but still see shares falls, and semiconductor stocks have corrected despite strong demand. So it's kind of the market's emphasis is changing from not how much money is being spent, but how will that return be generated? Where does the economic rent go? So it's not a questioning of the AI ecosystem story, but it's a questioning of will the benefits arrive, I guess, as quickly as markets are currently expecting, or what's in valuations. And it has been an earnings driven, not a multiple expansion led re-rating this year, which makes it very different to, say, the .com era. There has been strong earnings continuing.
So where is the next phase of the AI story?
Yeah, so I guess it's very kind of elaborating on the last question you had. It's that moving from the AI build out to the AI monetization. So if you think about where we've come from in this AI journey, the first phase really rewarded NVIDIA, for example, chips, memory. We've seen some memory stocks be up like 300% this year, data centers. And now perhaps the next phase is more about software, automation, productivity. How does that through to corporate margins eventually? Cost reduction, earnings growth. And so the winners may, again, not just be those CapEx hyperscalers, but businesses that are starting to show that they're successfully using AI rather than just building AI. So we're seeing the market broaden into healthcare, financial services, enterprise software could become major beneficiaries. So there's a lot of narrative creep, and I think I've spoken to you before about just this years and years of narrative creep from headline risks. It seems that the market direction is changing on a fortnightly basis and quite aggressively, and the rotations related to that.
That's Nick Schoenmaker there. Now, we will continue talking to him because executives from construction group FDC Consolidated rang the bell at the ASX today. The diversified construction company raised $400 million, meaning it's the largest IPO locally this year. Its shares soared 17% on debut today and closed 12.3% above its offer price. Local investors are clearly open to such investments. And a few weeks ago, if you remember, ComSec said it received a record demand from retail investors to access the SpaceX IPO, which listed in New York. So, will the day one success of FDC translate to more listings on the local share market? Here's more from Nick Schoenmaker.
It's safe to say that the IPO market is improving, but one deal, doesn't make a trend. I think the valuation came out about $1 billion or $3 a share, I think. And as you said, it's been up nearly 20% on debut. So it's an encouraging sign. And I guess you can say that investors are showing they're willing to support profitable and also understandable businesses. So very different to SpaceX on a number of metrics. Globally, like you said, with SpaceX, we're seeing demand for, let's call that a scarce growth asset. Australia does remain a lot smaller, and it's a much more valuation sensitive market than the US. So I guess the key question is just whether FDC success encourages the next wave of listings. IPO markets don't tend to reopen all at once. It's kind of like one deal at a time. But one of the global themes we are seeing is that a lot of companies are becoming private for longer, and we're seeing now companies like Anthropic and OpenAI are going to be huge companies by the time they list, like SpaceX. So there is a lot of more value creation happening in the private markets before public. So it's a bit of a wait and see as to how things pan out post this for the Aussie market. But as I said, encouraging first step, given how big it's been.
Okay, and in wrapping up, where do you see the opportunities for investors at the moment?
I mean, so maybe just on that AI theme, because AI has become such a prevalent theme that it's driving national security, it's driving defense, it's driving GDP growth in the US through the wealth effect, through the capex. It permeates through every single asset class at the moment. So just thinking about AI, focusing on the beneficiaries, perhaps maybe than the builders, it's still a structural major growth opportunity, but I think investors start to need to broaden their thinking. So, we talked about going into perhaps the next generation benefits from software businesses, AI productivity beneficiaries, healthcare technology, financial technology, just to focus on quality companies with pricing power. And now energy remains really important because it sits at the center of this whole inflation and economic growth debate. And we've spoken before, I think, about we are in this whole new world again, where you have these two mega forces that are very hard to reconcile. You've got AI and this technological super cycle, and geopolitical fragmentation and polarization like we haven't seen since the days of World War I and World War II. So, we are in a whole new world again, and portfolios need to adapt to that. So one thing we think a lot about is moving a little bit away from asset class silos per se, because of some of the concentrations in markets and indices that AI thematic, and thinking a bit more from a total portfolio approach. What are your economic exposures? So really thinking about diversification from an economic exposure lens.
That's Nick Schoenmaker there from Portfolio Construction Management, and he wraps up the podcast for this Thursday. Give it a like, review and subscribe if you enjoy it. And don't forget, you can watch On the Money during the 6:30 weekday edition of SBS World News on SBS. The podcast returns tomorrow. It drops after the market close, and I'll catch you then. This SBS On the Money podcast is provided for informational purposes only and should not be understood as constituting advice or a recommendation. It is not personal advice, and it does not consider your personal circumstances or objectives. You should contact a licensed professional before making any financial decisions.